We frequently fault our governments for their inability to accomplish large projects, particularly when discussing major public works and infrastructure initiatives. The United States has recently featured in headlines for its federal infrastructure proposal, which promises to dedicate more than $1 trillion toward repairing and upgrading infrastructure nationwide. Already, the initiative is drawing critiques from those claiming this won't resolve the nation's deteriorating infrastructure. The same holds true for smaller undertakings, which appear inevitably burdened with delays and excessive costs. This is unfortunate because spending on infrastructure can often be one of the smartest investments governments make. In the short term, it functions as a kind of stimulus. Bridges and highways do not construct themselves. They require workers, designers, planners, engineers, and certainly occasionally some environmental analysts. Much like a stimulus payment, this channels funds directly into households and helps reduce unemployment rates. However, unlike stimulus checks, the resources are actually going toward building assets that will continue to deliver worth to the broader economy long after the initial payments have faded. Projects such as the Hoover Dam were created partially as a method to employ people during the Great Depression. Now, nearly a century later, the structure still supplies water and power to millions of residents. Infrastructure investment, in short, is outstanding, and it is also broadly acceptable politically. Nobody disputes that wages paid to workers on these projects are deserved and not handouts. And most modern infrastructure also aids producing renewable energy, reducing travel times or otherwise. Infrastructure investment is excellent, which may explain why frustration grows when initiatives never progress or instead become tangled in bureaucratic layers and prolonged processes of consultants and red tape. Consider examples from nations such as China, where infrastructure initiatives seem to happen with remarkable efficiency. American roads and bridges are deteriorating rapidly, while China is completing feats of engineering previously unimaginable. China constructed a complete hospital in 10 days, while San Francisco spent a decade approving a single bus route. California has devoted 2 decades planning a rail system. In the same time, China has built the largest globally. And if you think I'm merely criticizing America, my home city of Sydney invested over $3 billion and more than 4 years constructing trams, which combine every congestion issue of buses and trains. It becomes clear why observers assume China's approach is working, though regrettably it is not. China's high-speed rail system became the centerpiece of the nation's infrastructure expansion, the crown jewel of China's construction surge, and a public statement to the world that essentially proclaimed, "We are better than you." The network is undeniably remarkable, but it also threatens to create challenges for the Chinese economy that could make Evergrande appear like a minor distraction. So how was China able to construct such an enormous high-speed rail system so quickly? Why did it invest in building such an extensive railway network? And finally, what was the true cost of bringing this massive project together? China is a vast nation with a large population inside it. It is also a country where owning a car is considered somewhat of a luxury. For these reasons, a strong rail system became essential for offering an affordable and effective way for citizens to travel. For a long period, this need was mostly overlooked because most workers would spend their whole lives living in the same city where they were born. Travel across regions was minimal, and therefore demand for such a rail system was not yet significant. This began to change in the early 2000s. By then, the nation's strategy to open internationally was already progressing strongly. Increasingly, young workers moved from smaller towns to larger cities to provide labor powering the country's growing industrial and manufacturing sector. These workers still wanted opportunities to return home to families, but travel costs by air or car were unaffordable for most. Before high-speed rail, workers relied mostly on bus journeys that could take days or weeks for relatively short distances. By 2008, the Chinese government had already begun preliminary high-speed rail projects, but the global financial crisis accelerated these initiatives significantly. If you'll pardon the pun, China was not shielded from the impacts of the GFC, and trade dependency then was even higher than it is today, while trade activity during that period dropped sharply. We explained trade intensity in detail in our Brexit video 2 weeks ago, so if you want a complete explanation of that term, you should check out that earlier video, but simply, falling trade intensity meant imports and exports declined, which for China was troubling. The response to this economic shock was fiscal stimulus, but China hesitated to simply disperse cash because they were unsure how long this crisis might continue. Instead, they chose to employ workers who might otherwise lose manufacturing jobs abroad and reassign them to work constructing high-speed rail infrastructure. Keynes half-joked about this exact approach during the 1930s. He argued that an effective stimulus method could be to bury currency underground, because then stimulus measures would create work recovering the money, which would show favorably in unemployment records. Of course, if the stimulus creates something beyond a well-dug field, that is better. The high-speed rail program fulfilled this purpose, employing millions directly, with the Beijing-Shanghai line alone having over 100,000 on-site employees, and that excludes other workers in factories producing steel, cement, transporting supplies, or simply delivering goods and services for the workforce building these enormous tracks. It was largely because of this extensive high-speed rail program that China avoided slipping into recession. So clever, right? Mission complete, China escaped recession, and they gained a vast high-speed rail network, allowing workers to easily travel across the nation, further boosting living conditions and industrial productivity. Well, this is where complications begin to emerge. From the very start, the railway project was tainted by corruption, which is somewhat expected with many public infrastructure initiatives, particularly those executed in China. But this was among the largest and most visible projects ever, so corruption scandals inevitably became larger and far more brazen too. This presented a challenge for the government, because it meant they could not boast openly about how impressive their new network was, without such claims being drowned out by reports of officials accepting bribes. These problems worsened in 2011, after a collision between two high-speed trains, which crashed on a track segment elevated some 20 meters above ground level. It was later discovered that the incident resulted from a chain of management failures that had overloaded the system. This seriously damaged public trust in the high-speed rail system into which China had already poured hundreds of billions of dollars building. It also revived fears about corruption and nepotism entrenched within the now expanded Ministry of Railways' bureaucratic structure and operations. The government's response to this crisis was to partially privatize the railways by transferring them to the state-owned corporation China Railway. A year later, the two firms responsible for producing trains, CSR and CNR, merged to form CRRC. These were two enormous state-owned enterprises which embarked on the largest construction campaign seen so far. Because these companies were legally separate from government control, they gained greater autonomy over how much capital they could raise. They borrowed close to $1 trillion to develop China's railways into their current state and secured this funding through a mixture of state bank loans, publicly issued bonds, and financial support from various local governments. Almost. As soon as the final track segment was laid in this latest construction effort, a range of new difficulties began to emerge. By the time China Railway had launched its most recent building effort, most of the most profitable routes linking major cities were already complete. This meant new routes were being built to city centers that would not generate comparable passenger demand and therefore would not produce equivalent revenue. These projects continued to be advanced by the government because they wished for these smaller cities to have connectivity, even if profitability remained low. Several motivations lay behind this, many of which were political. Sam from Wendover Productions made an excellent video about this, so if you are curious about the details, go watch his coverage of the subject. Aside from flawed political reasoning, other issues were apparent as well. China's high-speed rail system became such a symbol of national pride that planners seldom questioned whether there was a more effective solution to solving the challenges of transporting people efficiently across the country. If you manage the Ministry of Hammers, every issue starts appearing like a nail. Likewise, if you control China Railway, every challenge looks solvable by building another high-speed train. The trouble was that wasn't necessarily true in every circumstance. High-speed rail is technically remarkable and draws a great deal of attention from international observers, attention which the Chinese government greatly appreciates. But in some cases, there are superior alternatives available to consider. Standard rail, for one example, comes to mind immediately. Conventional rail is much less expensive to construct and operate, which ensures that ticket prices remain significantly lower, which matters greatly for cost-conscious workers who remain relatively poor compared to average standards in many Western countries. Conventional rail also brings advantages through its ability to transport freight, which for a country reliant on heavy industry like China is extremely important indeed. For a period and considered in isolation, China's high-speed rail network seemed excessive but manageable. Losses from unprofitable routes were compensated by revenue from the most profitable routes, and the state-owned corporation was even able to generate a modest profit itself after servicing and paying off its enormous accumulated debt obligations completely. This fragile balance broke down in 2015, however, and since then, interest payments on outstanding debts have consistently outpaced the operating profits generated by the network. A variety of issues have worsened this. Tracks are now aging and increasingly require expensive maintenance. Rail operators cannot raise fares without losing customers to air travel or bus services. And then COVID struck, collapsing demand almost completely for rail tickets, making nearly every line deeply unprofitable almost overnight. So, now China faces a state-owned company, burdened with $850 billion of debt that it simply cannot repay under current economic conditions effectively. Ironically, this has happened at a time when fresh fiscal stimulus, similar to the 2008 high-speed rail expansion program, would once again be desperately required to respond. Obviously, that is not going to occur, and the government has already stopped construction entirely on any new high-speed rail routes across the country completely. But this doesn't mean they are suddenly free from the problems that maintaining the existing network will inevitably continue to produce over time if they attempt to privatize parts of the network to repay outstanding loans. Then any profit-driven corporation would only consider acquiring the most lucrative routes. This would force the government to subsidize unprofitable lines using taxpayer money, which would become a significant and ongoing drain on public finances permanently. Alternatively, they could simply shut down these railways entirely and permanently, but that would result in the loss of hundreds of thousands of jobs and destroy one of the greatest symbols of China's economic achievement in decades. The last alternative is a government bailout and full renationalization of the railways. And yes, I know China Railway is technically state-owned already, but it retains autonomy that real government ministries do not have under the current administrative structure. None of these choices are particularly attractive, especially during a period when China is facing the simultaneous threats of a housing crash, energy shortage, and long-term economic consequences caused by an ongoing global pandemic crisis. I am always cautious when attempting to predict the future with certainty, but it is difficult to imagine China simply ignoring all of these mounting challenges. If nothing else, let this recent challenge serve as a powerful demonstration of why large-scale projects such as railways, highways, and bridges require careful planning and thorough execution in every country that intends to build them properly. You may become frustrated by red tape, and I certainly do too. But perhaps pointing to China as an example of efficient delivery is flawed, and not the best way to argue about the shortcomings of our own governments.